Hello, good morning, good afternoon. Let me give a few seconds for everyone to get in. We'll go ahead and get started. So I'm Kim Allison. I am over the marketing and business development at CDC Federal Credit Union. I've been here almost 3 years, and I've been in the credit union industry since the early 2000s. So I absolutely love talking to all of you about your financial decisions and helping in any way I can. So let's see. Okay, I see the people rolling in. And my contact information is on that main screen right there, kallison@cdcfcu.com. I will be following up today's webinar with an email. It'll have information in it, a worksheet or two, and I always collect all the questions that I get in chat and put them in the follow-up email along with the answers, and especially if I don't get to them today. And if you have to drop off early or for whatever reason, you will receive a link to the recording. So no worries there. Okay, so thank you everyone for joining me for Steps to Financial Freedom. Again, I'm Kim Allison, and I'm with CDC Federal Credit Union. So let's start off with a question today. If you wouldn't mind popping into chat, what is your definition of financial freedom? What do you consider, or what would you consider to be financial freedom? What are you trying to strive for? Do I have any takers? Is everybody shy? Okay, no debt. No, that's excellent. Okay, that's a great thing to strive for. Little to no debt, being work optional, time freedom, debt free. Okay, so yes, a lot of people would like to be debt free. Ability to make any decisions I want. Okay, that probably ties into optional work being optional, or maybe doing something that pays a little less that you would enjoy more. Okay. Planning for future, understanding options. All right. Great answers. Well, all answers would be great because everyone's idea can be different. So in today's webinar, we will cover 10 steps to financial freedom. Again, financial freedom means something different to everyone, and these steps are designed to set you up to work towards whatever financial freedom means for you. Some steps may not apply to your definition. We'll talk about understanding your money personality, setting financial goals, creating a budget, saving, using credit wisely, preparing to purchase a home, investing, insurance, record keeping, and the importance of reevaluating your finances regularly. So we're going to talk about a lot today. So make sure you got your note taker ready. Have you ever wondered why you use money in a particular way? Many forces impact the development of your money personality. You make purchases to fulfill desires and to make yourself feel a certain way. Some spending influences can include advertising, media, society, friends, family. One way to evaluate your approach to money is to identify your attitude about money, which is the first step to financial freedom. So do any of these money personalities sound like you? You might find that your approach to money is a combination of more than one of these personalities. So the hoarder likes to save, budget, and prioritize, while the spender likes to spend. The planner is the nitty-gritty, take it one step at a time type, and the dreamer hatches passionate schemes, but has no idea how to make them come true. The risk taker loves being adventurous, while the risk avoider goes for the sure thing. The separatist wants to have at least some of his or her own money, while the merger wants to pull everything, all the couple's money in together. Pop into chat what you think your money personality is. And it doesn't have to be just one. I have probably been every single one of these money personalities at one point in my life. So pop in what you think your money personality is. Spender, yes. I've been there. A planner, okay. Hoarder, risk avoider, okay. So one thing to note is that there's not a bad or a wrong. It's understanding what your money personality is. That's the first step, because unless you know you're a spender, you're not going to take precautions to make sure that you don't overspend. Risk avoider, separatist, okay, all of them, yes. I'm with you. It's kind of, I've gone through different phases to be all of them, yes. Okay, wonderful. All right, so let me have you guys take out a piece of paper and list the products and services you enjoy spending money on. Or you can make notes on your computer or on your phone. So go ahead and list out some things that you're spending money on, that you enjoy spending money on. Now, consider which of those spending habits you feel good about. For example, you may be spending money on a gym membership, which helps you stay focused and in good health, and you feel this is a good way to spend your money. I know that I spend money on yoga. I probably spend a lot more money on a yoga membership than most people would, but I think it's a great value because it's something that I try to do every day. Doesn't happen, but try to do 4 to 5 times a week. So I think it's worth the money. You might eat out regularly, but you're okay with that because it's in your budget and it allows you to spend more time with your family and friends. So write down what you're spending money on and what you actually feel good about. And people are putting stuff in chat. So take out food, TV apps. Okay. At the same time, are there any spending habits you don't feel as comfortable with and would like to change? So what you understand your money personality and attitude towards money, or when you understand your money personality and your attitude, this can help you consciously make adjustments and changes as needed to help you achieve your goals. Let's see. Okay. Clothing. Oh, we got another yogi here. Okay. Going out to eat, travel, clothes. Okay. Are these things y'all are happy about spending money on or wish you could spend less on? Are we looking to change some of these items? Let me know in the chat. So needing to adjust your spending habit, this brings us to step 2. Know what you are working towards and which will help you determine if changes in your spending habits may be necessary to get there. The next step towards financial freedom is setting financial goals. When you are setting your goals, keep the following things in mind. I'm going to hop back over to chat because I saw some more stuff coming in. Okay, streaming, gas bills, spending, medication, doctor bills. Gotcha. Okay. So maybe not things you enjoy spending money on, but you have to. The first is to make the goal specific. How much do you need to save? How long of a time frame do you have before you need the money? How many pay periods are available to save the money? And I'll give you an example here. So maybe you decide you need $5,000 to save $5,000 over, say, 2 years. If you get paid once each month, you need to save $208.33 each pay period to achieve your goal. Next, the goal needs to be measurable so that you can monitor your progress. Do this in a way that makes sense to you. Determine whether you will save towards your goal each pay period or each month. Check in on your progress towards your goal regularly. Track your progress on a computer or in an app. Maybe you just write it down, or by reviewing your savings account balances. Having a goal you can measure progress on is key to being able to achieve it. And finally, is your goal reasonable and realistic? You want to set yourself up to reach your goals. Don't try to save so much each pay period that you don't leave yourself sufficient money to cover your other expenses. You might have to lengthen your time frame to achieve a goal and decrease the amount you save each time to ensure your goal is realistic and can be reached. Remember, saving is a lifelong process, and a consistent and systematic approach will often pay off. Keep in mind that goals will be short-term, which goals can be short-term, which would typically be something you plan to accomplish in less than 2 years, and sometimes even less than that. An example might be a family vacation next summer. So we've got, roughly a year for that one. So please share in the chat some examples of your short-term goals. Does anyone have any short-term goals they would like to share? Something less than 2 years. Pay off solar panels. That is a very specific goal, and I love it. Okay. You got specific, and I'm sure you know the exact amount for that too. Okay, credit cards, pay off car note, pay off car before time, pay off windows. Okay, wow. So there's been some home improvement going on. Pay off credit cards, pay off credit card debt. Okay, so there is a system to pay off credit card, or systems, different ones to pay off your credit card debt. That is not part of this webinar today, but that we might still have it on our YouTube page. But paying off credit card debt, there's several different ways to do that, and it goes back to your money personality, which one would work best for you. But paying it off kind of has to start with, well, it definitely has to start with planning, and it needs to start with not using the cards. Okay. All right, so I'll get off of that. Let's see. Okay, so you can also have midterm goals. That will be, those will be accomplished like 2 to 5 years, like saving for a down payment on a new car. Share in the chat if anyone has any 2 to 5 year midterm, mid-long goals. So anything that they're planning for 2 to 5 years. Buying a new car, okay. Oh, first vacation with your husband, I love that. Okay. Purchase a new house, yes. Retire, move back to the hometown. Those are big goals. I love them. Well, this is good. This is a good way for you to get started and knowing that you're on the right track. And then additionally, you can set long-term goals that you will probably be saving towards for quite a while. Typically 5 years or longer, like a down payment on a house or enough money to retire comfortably. Please share in chat if you have any long-term goals. Anyone in the market for a house? I know that all of our long-term goals is saving for retirement, so you don't need to pop that one in there. And if it isn't already one of your long-term goals, let's go ahead and add that today because it should be. Retirement, retire comfortably, buying investment property, buy land. Okay. Yep, big goals. Okay, so in my follow-up email later today, or it may be tomorrow, I know people get excited and they want the email right away, but it takes a little bit of time for me to get it all together. I'll send you a worksheet to help you with setting these goals. It's specific and I think it's a fillable PDF, so it's fun to work with because you can use it for different things. Okay. But in the meantime, start thinking about what financial goals you would like to set for the next 1 to 2, 2 to 5, and then 5 years. In order to know your goals are realistic and to have a plan to reach them, it's important to know how much money you have to work with. A budget is your plan to achieve your goals. So step 3 is creating a budget. Will you guys add into chat if you have ever tracked your expenses in detail for a month or 3 months? Has anyone done that yet? Tracked their expenses for an extended amount of time? Okay. Did you enjoy doing that? Did anybody did anybody enjoy tracking their expenses? And whether or not you enjoyed it or not, doesn't matter, but did you learn anything? Did you learn something about yourself that you didn't know? Or were you shocked about how much money you were spending on something? Not enjoyable, but useful. Retire comfortably. Okay. Oops, there's a lot coming in. Hold on. Oh, takeout and gas tied. Interesting. Felt a sense of control. Yeah, need more income. I know we all are there. But the sense of control, I'm happy that you shared that because that is you taking ownership of what you are spending your money on and understanding where your money's going because that will be the first step. That's great. Prices of everything is steadily going up. Yep. And Amazon. Okay. All right, so in the most basic form, a budget includes the money you have coming in and everything you need and want it to go out towards. It is not until you know where your money really goes that you can alter your behavior and thus reduce or change expenses in order to free up money to save for or achieve your goals. If you don't already have a budget, step 3 is to create one. Having and sticking to a budget is a key step to financial freedom. Start by identifying your income and debt payments, as those numbers tend to be similar from month to month. Then work to get an understanding of your variable expenses, which often seems to be the most challenging for people. Don't forget to include periodic expenses in your budget, such as car insurance or property tax. Periodic expenses tend to sneak up on people because they have not budgeted ahead of time for them. This can derail progress towards your financial goals and potentially escalate debt. People often find opportunities to save money by making small habit changes in a variety of expense categories. Identifying ways to change spending habits that will free up money to reach your goals can be exciting. while these are recommended ranges as you set goals for your own budget, everyone's budget can and will and should look different based on your financial situation and goals. I want to reiterate this. Your budget should reflect your financial situation, your financial goals, and your financial priorities. If being able to go out to eat regularly is something that is a priority to you, or I saw takeout a lot, if that's a priority to you, it's okay if you're eating out. Budget is larger as long as you have accounted for it in your budget and are comfortable that your needs, other needs, are met and goals are being worked towards. Creating a budget with your goals, situations, and priorities in mind so that you are sure it is realistic for you to stick to is the biggest tip for creating a budget that works. So if you know you're someone who likes to get takeout all the time, or what's another one? Amazon. Well, I know we can all probably decrease there. Or if Sam's, Costco, that got me too. I had to cancel my Costco membership. I was buying things I didn't even need. Sorry. So just knowing what your financial goals are and your priorities will help you be able to adjust some of these. And like I was saying, if takeout is really important to you because you get home late and you don't feel like cooking, then put that into your budget and know or be realistic about it. If you're doing it 5 times a week now and moving forward, you're like, I'm going to cook every single night. Well, that's not realistic. But maybe being realistic would be I'm only going to do takeout 3 times a week versus 5 times a week. And that could and should be doable, right? If you prep some stuff over the weekend. Okay, so it's easy to think that if you only got a raise, you could reach your goals. But having more money coming in without a plan of where you want it to go can easily lead to that goal feeling even further away than it did before. This is called lifestyle creep. Whether you have $10,000 a year coming in or $1 million, having a plan for where those dollars will go is key to reaching your goals and experiencing financial freedom. Okay, so let's talk about the importance of savings. Our fourth step to financial freedom is making a plan to save money. Many of us pay our bills first, then we spend on a regular basis, and then at the end of the pay period, there is no money left to save. Including savings in your budget and treating it like any other bill can help you get into a disciplined method of paying your future self first. Setting up an automatic savings transfer on payday can help with this. If it goes to your savings account automatically, many people don't miss the money. But if they have to actually make the transfer themselves, they may be good at talking themselves out of it. Commit to start treating savings like a budgeted expense now. Start with a small amount each paycheck. One little tip I would like to offer is set it up as a percentage versus an amount, because as your pay grows over the years, it will grow, you will be saving more as well without ever having to adjust it. So reevaluate your budget regularly to look for opportunities to increase the amount you are saving over time. Get a raise, pay off debt, increase your savings transfer. So if you get a raise and it's set to a percentage, you don't even have to change it. Okay. An emergency savings account is money you have tucked away for unexpected, unavoidable expenses. This may be things like an unexpected car repair, a medical or vet bill, a home appliance replacement, or unexpected travel for a family emergency. Having money in a separate savings account for these unexpected emergencies helps you avoid having to turn to credit cards when these expenses arise. Keeping your emergency account separate from other savings ensures you have money dedicated to those unexpected expenses while also working towards other savings goals separately. Clearly define with those you share finances with what an emergency truly is and commit to only touching these funds in those situations. We mentioned periodic expenses before when talking about budgets. These may be things like regular car maintenance, holidays, birthdays, anniversaries, insurance, vacation, and other expenses you know you will have from time to time, but not every month. Sinking funds are designed to help you be financially prepared for these unexpected expenses so you don't find yourself caught off guard when they arrive. This is the second page on the worksheet. I know you don't have the worksheet yet, but this is also included in there, so you will be able to fill in your periodic expenses. So estimate, just you can do this on a piece of paper, how much money you will spend in the following year in each category, and divide those numbers by 12 to determine an amount, a monthly amount, to save for each anticipated periodic expense. This helps you treat periodic expenses as monthly expenses in your budget. You can even take it one step further and divide each expense by the number of pay periods per year. If you get paid every other week, that is 26 paychecks per year. If you anticipate spending $1,000 during the holiday season, divide this by 26 pay periods, and you'll see that saving $38.50 per pay period is your holiday spending fund. And this will ensure that you have $1,000 already available when the holiday season rolls around each year. Consider setting up a separate savings account for your sinking funds to ensure you are using this money for the intended purposes. Okay, so we've talked about budgeting and savings, but occasionally there may be a purchase you need to make that is larger than the cash you have on hand. This is when getting credit can come into play. And step 5 is using credit wisely when these situations arise. Credit is a tool that can be used to purchase expensive items without having to save for years and years to pay for them outright. It can also be used to manage your budget and track your spending. However, if not used responsibly, credit may get out of control and create many hurdles you will need to overcome. Credit is not extra money that you can access without having a solid plan to repay the amount you borrow. As we discussed earlier, know your money personality. If you are a spender or a risk taker, you may want to avoid carrying credit cards to avoid impulse buying. Create some clear guidelines you will use and develop an accountability system to stick to those guidelines. Like we discussed in step 4, make sure you have savings built into your budget for emergencies and periodic expenses. Having funds saved for these situations will make it easier to use credit wisely. Avoid using credit to charge unnecessary items if possible. If you need to charge for an unexpected expense, prioritize paying it off as soon as possible. To maintain a good credit score, Keeping your credit card balances under 30% of the credit limit is recommended. If you max out your credit card, your credit score will likely drop. Also, late payments can have a quick and significant negative impact on your credit score. If you are concerned you will not be able to pay a bill on time, reach out to the creditor, especially if this is a temporary situation. The sooner the better. Creditors can't help if we don't know what is going on. If you are not sure it's a temporary situation, we partner with a nonprofit credit counseling agency called GreenPath. I will share their information at the end of the presentation. And finally, be sure to check your credit report regularly for accuracy. You are entitled to obtain a free copy from each of the 3 credit bureaus every week at annualcreditreport.com. Again, that's annualcreditreport.com. That is the only site that it is free and doesn't try to upsell you. Okay, I was checking chat. Okay. Buying a home is typically the largest purchase most people will ever make. So if buying a home is one of your financial goals, step 6 is making sure you are prepared before this massive purchase. Mortgage lenders don't look at all of your expenses when pre-approving you for a certain mortgage amount. Before talking to a mortgage lender, evaluate your budget closely and determine what you feel comfortable spending. Do you anticipate any changes to income or expenses in the next few years? Let the potential lender know both the overall purchase price and monthly payment ranges you are comfortable with, and work with those numbers. You may hear a lot about down payments, but buying a home can involve a variety of additional upfront costs that are important to be aware of and prepare for. So not only will you typically have costs associated with the actual purchase of the home, but you will want to be sure you have emergency savings for anything that goes wrong once you are a homeowner. New homeowners typically want to purchase new furniture or decorations to make their new home their own. So having money tucked away can help you avoid going further into debt. Most lenders prefer you to spend no more than 28% of your gross monthly income. This is your income before deductions on the principal, interest, and taxes, and insurance for your new mortgage payment. I'm going to repeat that. Most lenders prefer you to spend no more than 28% of your gross monthly income on principal, interest, taxes, and insurance for your new mortgage payment. Add this anticipated payment to your other monthly debts, and they typically don't want that amount to exceed 38 or 36% of your gross income. These calculations are known as debt to income ratio. In addition to your credit score, the debt to income ratio is weighed heavily in a mortgage lending decision. The following are examples of debts that could fall under this debt to income ratio: mortgage, car payment, student loan payments, credit card payments, installment loan payments. To reiterate, this ratio doesn't consider other expenses you might have outside of debt payments. You may have additional large expenses like childcare, which is why it is imperative for you to know what payment your overall budget can support, regardless of how much a mortgage lender says you could afford to pay, because they will not typically be looking at your entire picture. It's easy to think retirement is forever away and that you have plenty of time before you need to start thinking about and planning for it. That's why one of the first comments I made is everyone, no matter your age, should be planning for retirement, saving for retirement. So, however, the sooner you start saving for your future, the better, which brings us to step 7. Once you have a place to live, a budget that works for you, money tucked away for emergencies, and your monthly debt payments are at a comfortable level, building a nest egg for your future can begin or continue at an increased pace. Please know this is for general information purposes only. Please consult an investment professional should you like to get more information on investments that are best for you. Our financial advisor, Henry Chenault, offers a no-cost consultation, and you can schedule an appointment with him on our website, cdcfcu.com. When it comes to investments, the higher risk option usually means higher returns, but can also mean bigger losses. This is another example of how knowing your money personality can help you make decisions. Are you a risk taker or risk adverse? This can directly impact the investment decision you make. And I know I saw at least one risk taker over there in the chat. I won't look back, but this is where it all comes into play. So to outline a free option, to outline a few options in general, investing in stocks means that you own a piece of the company you buy a stock in. It is important to seek professional advice as stock investing has many pros and cons. Bonds are issued by governments or corporations when they want to raise money. You buy a bond, which will have an end date when the principal of the loan is due, and there will be terms for the interest payments made by the borrower to you, the lender. Mutual funds let you pool your money and other investments to buy stocks, bonds, and other investments. 401ks and 403bs are retirement savings plans offered by employers for their employees. For government employees, the 401k equivalent is the Thrift Savings Plan, or TSP. The money saved in these plans is before tax, and the investments grow tax-free. Withdrawals in retirement are then taxed as income at that time. As part of their benefit plan, some employers offer a match to encourage employees to contribute to these savings accounts. Since this employer match is essentially free money for your future, prioritize making room in your budget to contribute enough to receive the full match every year to maximize this benefit. Consider automatically increasing the amount you contribute to your retirement plan when you get a raise. If you have it set up as a percentage, this will take place automatically, and you won't have to make those adjustments. Know there are limits on how much the government allows us to contribute to our retirement plans, and these can change each year, and they do. So make sure you check your annual limits. 2 other retirement savings accounts are the traditional IRA, individual retirement account, and the Roth IRA. As implied by the name individual retirement account, these plans are a great option for people that don't have access to an employer retirement savings plan. The traditional IRA is similar to the 401k in that contributions are tax-free, investments grow tax-free, and withdrawals are taxed as regular income. The Roth IRA contributions are made after taxes are deducted. I'm sorry, they are made after taxes are deducted, at which point investments grow tax-free and withdrawals are also free of tax. Roth IRAs can also be used by people without access to an employer plan. What do you own of measurable value that you can't easily or affordably replace or repair without insurance? Step number 8 is to make sure those valuable assets are insured. Okay, yes, you will. I will send a recap, a follow-up email, and you will receive that recording in the email. So please pay attention or look over in spam if you don't see it by into business tomorrow. Okay, so auto insurance protects you against financial loss in the event of a car accident or theft. There are many things to consider when obtaining an insurance policy. Many states may have specific coverage requirements, which you will want to know for your state of residence. You will also need to determine how much coverage you need and how much the premiums will be. Compare with multiple insurance carriers to determine what you need and the cost of insurance with each provider. I try to do this once a year because insurance fluctuates, and it seems like the longer that I'm with the same carrier, the more my insurance, it just gradually goes up. And then if you're not paying attention to it, you're paying more than what you should be. Renter's insurance is intended to cover damage to or theft of your personal property, liability, and loss of use, but not damage to the building itself. It is important to know a landlord's property insurance typically wouldn't cover your personal belongings. Renter's insurance is usually very affordable and can provide you with peace of mind. Most lenders will require homeowners insurance on any property that is used as collateral for a loan. The amount of insurance you will need depends on the value of your home and your possessions. It is a good idea to take an inventory and discuss it with a professional before determining a coverage dollar amount. Even if you own a home without a lien, maintaining a home insurance policy is still a good idea. So those of you who are retiring, or maybe some people on here have already retired, make sure you keep that. If you've already paid off your house, make sure you keep that insurance. You may have spent years investing on that home and building equity, so this is a way to protect your investment. It may be odd to consider your health as an asset, but it is. Determine your health, dental, and vision needs and what coverage makes the most sense for you. Does your employer offer insurance plans that meet these needs? Your life is your biggest and most valuable asset. Life insurance provides financial security and helps ensure there are funds to pay off debts, pay living expenses, and pay any medical and final expenses. Review your assets and obligations to determine the amount of life insurance coverage that would meet those needs. Talk to an insurance professional to determine options and cost. There are 2 primary types of life insurance, term and permanent. Term life insurance provides coverage for a specific amount of time, say 20 years. If you outlive your term, you would be responsible for securing a new policy to continue being covered. Permanent or whole life coverage provides you with an insurance policy that you can continue for your entire life and does typically cost more. Long-term disability insurance is intended to cover lost wages due to a disability and can last a specific term or until you are eligible to draw Social Security. Long-term care insurance will cover a daily amount for services to assist with activities of daily life. The cost of long-term care can vary greatly depending on age, reimbursement amount, and other optional benefits. Our financial advisor I mentioned earlier, Henra Chenault, can also help you with these types of insurance products. We have talked about a lot of things today that will involve paperwork and records. Keeping your records organized and easy to navigate is essential to managing your money. So step 9 is keeping good records. First, you will want to gather all important documents. So credit union and bank information, investment information, tax filings, insurance policies, debt obligations, your titles, any legal documents, your will, your trust, if you have that, passports, birth certificates, marriage license, and of course, Social Security card. Next, determine where and how you want to store them. If you are storing them in a filing cabinet or safe, make sure it is organized and secure. Store similar documents close to each other so that they're easy to find, and consider a fire-safe record storage solution. As you get new accounts and policies over time, be sure you update those records regularly. If you prefer to store your documents digitally, make sure you choose an encrypted and backed up storage solution so you don't lose access to important paperwork. And then step 10 is reevaluate regularly. None of the steps we discussed today are a one and done thing. All of these steps to financial freedom are ongoing and require reevaluation as your financial situation and goals change over time. Okay. It is 7 years. Destroy after 5 years. I would keep everything for 7 years if you're talking about taxes. Okay. On at least a quarterly basis, revisit your budget to make sure it is meeting your needs and is an accurate reflection of your current financial situation. Make changes as appropriate. We also encourage you to quarterly evaluate how much you are contributing to savings and determine if you can increase that amount. This is especially important when you are just beginning to build those savings muscles into your budget and are starting with a small amount as you get in the rhythm of a budget. On at least an annual basis, review your credit reports from annualcreditreport.com. Is everything accurate, and were you aware of everything reported? How do you feel about your debt load? Are there any changes you would like to make to your credit usage? Also, revisit your financial goals at least once a year. Which goals have you reached? Which goals have you changed? How are you progressing towards your active financial goals? Are there any changes to make in your budget or spending habits to ensure you are on track to reach your goals and account for new goals? Taking a look at your investments each year is another great habit to get into. Are you in a spot where you can increase the amount you are investing? How is your current portfolio performing? This will go back to those risk takers and risk avoiders. You don't want to be too far on either one of the scales because then your portfolio won't produce much. Or if you're too much of a risk taker, then you might lose money. So you got to find where you're comfortable, but somewhat of a middle ground. How do you feel about the performance? Is it time to consider any changes to your investment portfolio? Is it a good idea to shop around for insurance policies that might better meet your needs and save you money? And finally, whether you store your records physically or digitally, go through your records at least once a year to make sure they remain organized and up to date. Consider which records you may be able to securely dispose of. So if you would like, I mentioned GreenPath earlier. If you would like to take a closer look at your specific financial situation, you are welcome and encouraged to call our partners at GreenPath Financial Wellness. GreenPath is a nonprofit organization that we partner with to provide resources to help our members lead financially healthy lives. GreenPath certified counselors can conduct a free confidential financial assessment with you. This involves taking a look at your budget with you and collaborating to develop an action plan to help you work towards your financial goals. GreenPath can also talk about other financial concerns or goals you have related to things like credit cards, housing, student loans, and debt. If you would like to speak with a financial wellness expert, you can call GreenPath or learn more on their website. And that is on this screen. You can see their number and website there. Also, if you are not a member of the CDC Federal Credit Union, but you're interested in joining, I invite you to join and I will give you the promo code FF26. So you can join rather quickly. You will need your driver's license, but you can use your phone and you can fill out the application from our website, cdcfcu.com. You click on the green button, apply. And when it asks for the promo code, you pop in FF26. And when you make your first $25 deposit, we will match that deposit. And I offer a financial webinar every month. The QR code on there goes to that page. So that will show you, and maybe you want to favorite that page if you want to do more of these. Next month's webinar is money management through transitions. So this could be any kind of transition. Maybe it's having a baby, maybe it's getting married, maybe it's retiring, maybe it's taking a new job, those types of things. So that's August 12th at 12 p.m. And if this one doesn't speak to you, that QR code, I update those quarterly. So there might be another one that, you like better. I do home buying webinars, auto buying webinars, credit score, credit reporting webinars. So there's always something for someone. You might want to take one month and not the next one the next month. But also, our financial advisor, Henra, offers webinars every month as well. Those are on his page on our website. You'll find under investments, you'll find his page, and at the bottom of his page will be his webinars. And I am updating those currently, so the August webinar will be updated soon. So let me see if I have any questions over here. Oh, I wanted to let you know, if you don't want to scan the code or for whatever reason, you can go to cdcfcu.com. You go under resources and then you'll see financial workshops tab. And I've got a few minutes left. So one thing I did want to point out is I saw a lot of people have credit card debt and want to get rid of that credit card debt. And a lot of times you get stuck in a vicious cycle with that. So if you aren't setting yourself up with an emergency fund and you don't have funds to tap into when something happens, say something with your car or the refrigerator dies or whatever, and you need, $500 or you need $1,500 and you don't have that saved yet, but you're trying to pay down your credit card. And then all of a sudden you got to charge $2,000 to the credit card again. And it's just this vicious cycle. So one of the first things that I do with people when you're trying to pay off credit cards is making sure that you have saved enough money for an emergency fund. That's your first step. You have to make sure you pay all your credit card, the minimum due on all your credit cards. But then in addition to that, start putting money aside for your emergency fund. So that's what I would do first. Okay, so do I have any questions? It looks like this is all from before. All right, well, if you guys do have any questions, feel free to reach out, kallison@cdcfcu.com. And like I said, I'll send a follow-up email with the recording and if there's any questions in chat that need to be answered, and then also those worksheets, because I think those are fun to use and it helps you, organize your thoughts and your expenses. So I will send that out as well. And in the meantime, everybody have a great week. And please join me on the next webinars. Thank you. Thank you, guys. Thank you.